Welcome to the Stock2Me podcast powered by IBN. This original audio production delivers market and sector insights, as well as exclusive interviews with innovative executives shaping the future in fast-moving industries, and may feature a client partner of IBN or one of the 60-plus investor-focused brands within IBN's dynamic brand portfolio. As a multifaceted financial news and publishing company, IBN leverages its extensive distribution network, utilizing multiple proprietary corporate communication tools to introduce both public and private companies to a vast and diverse audience of investors, consumers, influencers, journalists, and other targeted segments of the public. IBN may have received compensation to produce this audio content. Please be sure to read IBN's entire disclaimers for full disclosures. Now sit back, relax, and enjoy the next revelatory episode of IBN's Stock2Me podcast.
Thank you all for joining us for our latest podcast episode with the Senior Vice President of Corporate Services at OTC Markets Group, the largest U.S. stock market for international companies. Chris, it's a pleasure to have you on the show.
Good to be here, Jonathan. Thank you.
Thank you. So before we get into major misconceptions and key pitfalls faced by many, can you provide an overview of OTC Markets Group and its role in facilitating access to U.S. capital for non-U.S. issuers?
Yeah, sure. So as you alluded to, OTC Markets Group is the largest stock market in the US for international companies. And what I mean by that are that of the 12,000 plus securities that trade on our market, more than 90% of the order flow and the trading occurs in companies that are listed outside of the US. So good companies on good stock exchanges, but specifically those looking for US access. We have had more than $400 billion of dollar volume trade this year, and the total market cap of our markets is in excess of 27 trillion US dollars. So for perspective, of course, there's thousands of small and micro cap companies, but there are some of the world's best in class businesses there too.
Wow. So how does OTC Markets differ from traditional stock exchanges like Nasdaq and NYSE?
Well, as we're focusing today on the international side, for the international issuer, there's a absolutely huge difference between the two. So traditionally, you think of US markets, you think of the exchange model, so Nasdaq or NYSE, and again, they're great exchanges, but the rules are written to remove all risk. And when you do that, you take on SEC filing, which is of course just a form of disclosure, but it is completely different to the one that you would be responsible for on your home exchange, wherever that might be. So duplication of effort, reconciliation with US GAAP, so a completely different auditing cost and process. Sarbanes-Oxley, and the significant one, again, is D&O insurance, right? When you think about joining our premium markets, you can do so by way of an SEC rule, which is 12G32B. It's an exemption for taking on additional filing, meaning you can rely on your home market disclosure. So it's an extremely simplified way to get compliance with US securities laws and be freely tradable on our QX and QB markets. The US exchange model is duplication of effort, duplication of disclosure, and essentially millions of dollars to comply. The result is the same. You can be fully traded by as many retail and institutional investors and everything in between, but there's a vastly different cost and complexity depending on the route that you take.
Gotcha. And what are just some of the core benefits of the OTCQB and QX for international companies, particularly those in Canada?
Yeah, let's talk Canada. We've got just shy of 1,000 Canadian listed companies listed across all of the exchanges in Canada who look south of the border. So that's where we've got to be. So utilizing our QX, our top market tier, and QB, our venture market, I already mentioned that gets you compliance with all of the various things that broker dealers and investors and advisors need and managed accounts need to make investment decisions. That results in an increase in demand and trading in the ordinary share that, of course, is listed on a Canadian exchange. So it doesn't matter which Canadian exchange you're on. If you want to maximize your access to US investors, you join our QB/QX markets and you see increased trading volume. Significantly here, the flow is being taken in the States, but the US brokers then flip that trade to settle and clear and print on the home market. So Canadian exchanges love our business model. We're not draining the liquidity, we're actually injecting liquidity. So you end up with a more liquid home market, a better valued security, fingers crossed, if you execute on your business plan. And yeah, just increased US ownership, a few of the key benefits.
Awesome. And during the Toronto event you just hosted last month, there was an emphasis on the growth of non-US equity trading volume. What factors are driving this growth?
Well, it's no secret that the S&P 500 has performed particularly well when compared globally with other indices. But the reality is that US investors, just like investors elsewhere, want to invest in opportunity. And so if you think about the best in class companies that trade on our QX market, the likes of Roche, 200 plus billion in market cap listed in Switzerland, Heineken, Adidas, BNP Paribas, in Canada, Ivanhoe Mines, Air Canada, Bombardier, just to name a few. Those US investors want to be able to trade the stock. And so it doesn't matter, again, whether it's institutions who cannot or will not trade into foreign markets in different time zones in different currencies, or whether it's retail who rely on their Schwab or Fidelity TD E-Trade accounts, right? Your US ticker is playing a critical role in how people are able to or not trade in your stock. And so I think it's just global opportunity. We're seeing more and more brokers and institutions and sort of banks across Europe and Asia who want to consume our information because they have demand in turn for US dollar denominated securities. And so for a variety of reasons, we're continuing to see growth. But the headlines from that event that we hosted in Toronto was that Q3 2024, the quarterly volume was up 30% versus Q3 2023. And yeah, more than 90% of our 100 billion in dollar volume for the third quarter was in international securities. So I'm not necessarily going to be able to tell you exactly why that's the case, but we are the largest US market for international stocks.
Amazing. And what are just some major misconceptions non-US issuers have about accessing US investors, and how does OTC Markets address those?
There are a lot of misconceptions, but primarily for us, our role is education. And so when I say education, there's very few people out there that are actually experts in cross-border trading. So I would say that probably the biggest misconception that we hear from the C-suite at many hundreds of companies who come through the US and we get to chat with is that because they're listed on a high quality exchange and their disclosure is good, their corporate governance is good, there's an assumption that just passports them into the US and therefore everyone can trade their stock. And that is absolutely factually incorrect. And so the US is a complex environment. There's federal securities laws around reporting requirements. There's the state securities laws, like blue sky laws are a great example. There's very little point you coming into the States and maybe doing broker luncheons and hoping that advisors are going to be able to go out and solicit your stock, or maybe even the managed accounts, which makes up a tremendous amount of the dollar volume on our markets, right? There's the UBSs and the JP Morgans of this world where they're making investment decisions to buy blue chip stocks throughout the world and hold them in their portfolio for retail investors. None of that can happen if you, the issuer, are not compliant with each of the state securities laws. So it's very common for me to have a conversation with a great company, billion plus market cap business, high growth, doing really well, who simply don't realize that they're out of compliance in 46 jurisdictions in the US, so the doors are closed. So I think in terms of misconceptions, it's just an assumption that everyone can trade your stock because you're a good company, and not realizing that the US is a different environment. I would just underline the point here, I suppose, that when you're in the US and you Google a company and maybe you're on Yahoo Finance or any other financial portal, maybe it's a trading account. As you type in the company name, and it could be Adidas or BNP Paribas or Ivanhoe Mines or whoever it might be, up pops a US ticker. And so most US investors, again, whether professional or just retail, it's your US ticker that dictates how you are treated as a security within the US. So taking care of that, taking ownership of it, and taking advantage of some of the benefits of that is key to success.
Awesome. And can you share any success stories of non-US companies using your markets to grow their US investor base and just enhance overall liquidity?
Sure. Look, there's thousands of success stories. When you look at our premium markets, QB being a venture market is naturally much smaller companies, and those companies' needs are often different to a larger cap company. So I think if you look at QB, there's more than 700 Canadian listed companies that currently cross trade into the States on QB. Many of them over time have since upgraded to the top tier, the QX market. I've already mentioned some of the bigger names that trade internationally into the QX market. Roche has been on our QX top tier market from almost day one. So you're talking 15 years plus.
Wow.
And those best in class companies choose the QX as their US trading venue of choice. And so success stories, yeah, everyone from Heineken and EasyJet and Lufthansa and Air Canada, but right the way down to some of those smaller cap businesses who they just place a lot of value on the size of the US retail market. And of course, when you're small, you're a retail play until you're not. And ignoring the US retail side of the market, you do so at your peril.
Yeah, and we all know visibility is critical in today's markets. So can you maybe just elaborate a little bit on how programs like the OTC Visibility Program and virtual investor conferences enhance engagement with US investors?
Sure. I always talk about our markets as joining. Sure, you join our premium markets, but it's like joining a gym. If you do very little effort, you'll probably come back a year later and question the value. So we do put a lot of emphasis. We have a team of account managers here who engage with our QB and QX clients to talk about what the next 6 or 12 months looks like for them in terms of which conferences are they thinking of attending. We're often asked to help companies determine where they should be doing road shows, which conferences are valuable, whether it's large or small cap. And as part of that effort, we welcome companies to come into our market center in Manhattan, and we can record CEO interviews. We can do market open ceremonies. A big part of being on our market is using our tools to post your news and your financials so that we can redistribute it through to the broker dealers. And then you've already mentioned the virtual investor conferences. That's a great example. As the name suggests, it's convenient. You sit at your desk at home or in your home office, and you can present to a large audience. We host about 40 or 50 of these events a year, and they're extremely popular. There's a 2-day mining event going on as we speak, and those can be found at virtualinvestorconferences.com. But yeah, there's basically a program there to be taken advantage of, and the companies that see the most success on our markets, of course, are those that A, have the news flow, but B, carve out the time to go out and tell their story as aggressively as possible.
Yeah, and I want to also bring up your recently created white paper that highlights challenges with dual listing on US exchanges. What are the key pitfalls non-US issuers face, and why might OTC markets be a better alternative for smaller companies?
Well, I'll start with the last piece first. The OTC markets is by far the more cost-effective, efficient way for a small cap public company to access the US, right? We've already touched on the fact that it does not require SEC filing. It doesn't require Sarbanes-Oxley. Your D&O insurance isn't going to be hundreds of thousands, if not $1 million plus a year. And so for a small cap company, what we're saying here is you can access the US retail market without having to take on any additional burden. And so what we saw when we looked specifically at the IPOs on US exchanges over the last 2 years, and then filtered the data down to look at the sub 300 million market cap. So it's it is quite interesting when you just look at the numbers themselves, because you can draw your own conclusion. I will say that NYSE and Nasdaq, they're great stock exchanges, but the reality is that small cap companies, and don't forget in the US, if you're sub 2 billion in market cap, you're pretty small. They struggle. They struggle for visibility. So they struggle to garner interest. And now you spend $1 million plus as a small cap company to raise a small amount, but you've got duplicative reporting and you would love to be running your business as opposed to just dealing with compliance issues. One of the red flags is if you've got to reverse split to qualify, that's normally an indicator that you're trying to join a market that perhaps isn't the best fit for you. So I think suitability and market optionality is key in these conversations. And I'm not sitting here saying that OTC is the best for every company. If you're listed in Canada but becoming more of a US type of company, maybe your revenues and your management are more in the States, and you need to raise money that you can't do in Canada, maybe at some point it makes sense to re-domicile. But if you look at the 60 Canadian listed companies that were encouraged to cross-list, and I say encouraged because they almost certainly would have spoken to advisors and specialists, you look at the performance, and the performance makes for a dismal read. So again, I can take my opinion and my bias out of it. The reality is that the average performance of these companies in that Canadian sub 300 million space has been a 60% decline in valuations. And we can talk a little more about kind of why that's the case, but I just think that companies really need to think long and hard about whether this is needed or just a nice to have, and really question on behalf of the shareholders the spend.
Yeah, let's dive a little bit deeper into that decline in market cap post-listing. What factors contribute to it, and how does OTC Markets provide a more sustainable path to U.S. investor engagement?
So as we started to dig into the data, because it is kind of interesting when you see companies that naturally think the US is where we've got to be, and the idea of ringing a bell, it's quite exciting. But as you start to look at the data, it made us realize there was something strange going on, because markets weren't down 60%, and yet with consistency, I think all but one of these IPOs after 12 months was above the IPO price. And so something was going on. And so we started to look at the groups involved. And again, we call it lawful but awful. And what we found was that there's a group of, let's call them conflicted lawyers, advisors, and bankers who go out and tell a story around how easy and efficient and it is to list in the US, no matter how much money you're raising. And most of these companies did not raise a significant amount of money, but spend millions of dollars to do it. And the reality is that there's a conveyor belt of deals there where companies are convinced that that's a good path for them. And so the fact that there's more than 400 companies currently on Nasdaq and NYSE that are out of compliance, there's a red flag right there. Most of them are small cap. Most of them had to reverse split to get there. A quarter of those that did reverse split to get there had to do a further reverse split because within a year they're out of compliance from a pricing perspective. And then you start to see that there's warrants attached. Now, those bankers are getting paid on the deal itself. There's no need to pay them a second time. And I suppose one of the red flags is the fact that these small companies, they don't have loyal institutions that are coming in and holding the stock for the long term. Their shares are being placed with stock flippers who have no vested interest in holding the stock for any period. And so you look at the share price charts of these companies, it's a rapid downhill trajectory from which they'll probably never recover. They've diluted the shareholders. These guys are getting paid, paying themselves with warrants, which then gets released into the market. And so it's a downward spiral. So that's not the case every time, but with some real consistency, you can start to see there's some problems there. And so I would just say to any company that's listed in, this isn't a Canadian problem, but it's becoming more regular. If you're approached by a banker assuring you that they can raise X amount of money. I think you just got to sort of scratch away at that or peel away the layers of the onion and try and figure out exactly whether this is the right move for you.
Great advice. So how do you see the role of OTC markets evolving as globalization increases and more companies ultimately seek access to US capital?
Well, as I would have said to you every year for the last few years, we're going to continue to see more international companies join our market, right? There's still deep interest in joining the US and accessing, all the good things that come with it. I mentioned earlier that we are seeing increased interest from, certainly increased trading flow, but increased demand from Asian and European brokers, advisors, and investors. And so, one of the things that we did recently was launch our overnight trading. And so that now means that, if you think about it, if you're in Hong Kong and you want to trade 3 or 4 different companies' stock, and maybe it's Heineken in the Netherlands and Adidas in Germany and Ivanhoe Mines in Canada, that's 3 different currencies, 3 different times that the market's open. So one of the sort of big steps that we've taken recently is to launch this overnight trading capacity, and broker dealers are able to plug in and trade the stock over an extended period of time for more convenience, more efficient trading. Basically, just repeating a lot of what I said earlier in the conversation. The need to be in the US is right. There's a strong case to be here. The question is, how do we get here efficiently? And so we are, seeing that the increased volume, increased number of issuers, increased number of broker dealers subscribing to our data. And so I think we're going to see growth in all areas.
For sure. And are there any upcoming events that issuers and investors should look forward to?
Yeah, we travel the world hosting events. In the very near future. So I guess here we are in December. We're talking January. So I'm going to be in Vancouver with some of my colleagues at the Vancouver Resources Investor Conference. While we're in Vancouver, we're proud to be hosting a couple of events ourselves. And so at the Vancouver Club on the 21st of January, we look forward to hosting an educational session in the morning. Information can be found. You can contact me through my LinkedIn profile or seeking at otcmarkets.com. And yeah, look forward to meeting new friends, colleagues, clients. And then in the evening, we're hosting a client reception. So looking forward to all of that.
Yeah, and we'll be there as well. Very excited. It was amazing to see you all, in Toronto last month. And but as we wrap up here, I just want to say, it's a pleasure having you on the show. These insights, into the evolving role of OTC markets for facilitating international growth and just everything happening with the U.S. capital markets. It's really invaluable, and we look forward to following the exciting developments ahead.
Cheers, Jonathan. Thanks for your time.
The Stock2Me podcast is an original content production powered by IBN, a multifaceted financial news and publishing company that delivers next-generation corporate communication solutions. Utilizing proprietary corporate communication tools such as news aggregation and syndication, social communication, and brand awareness techniques, among others, IBN introduces both public and private companies to diverse audiences to enhance reach and recognition. IBN may receive compensation for services and solutions provided to its client partners. You should assume that the owners, officers, and directors of IBN or financial analysts mentioned in this production may hold a position in and may intend to trade the securities in their own accounts. This production is not an offer or recommendation to buy or sell any securities that may be mentioned in this production. The information in this broadcast is presented solely for informative purposes and is not intended to be or should it be construed as investment advice. As in all investments, investment in the featured companies carries inherent investment risk. Listeners should review the companies thoroughly with a registered investment advisor or registered stockbroker. This production by IBN is not purported to be a complete study of the featured company or other companies mentioned. Information used in statements of fact have been obtained from featured companies and other sources but not verified nor guaranteed by IBN as to completeness and accuracy. Such information is subject to change without notice. Please see IBN's full disclaimers and disclosures at www.ibn.fm/disclaimer. Music in this episode is by Infraction. For more, visit inaudio.org.